Hi folks, David Waring here again with LearnBonds.com, and today we're going to be talking about Treasury inflation protected securities, or TIPS for short. Inflation, meaning the general rise in prices year after year, erodes the purchasing power of your money. A meal that cost $100 in 2010 would have cost only $61 20 years earlier. Investors may therefore see an advantage in investments that build in protection against inflation. Treasury inflation protected securities are this type of investment. Their principal changes in accordance with inflation, or more exactly with changes in the Consumer Price Index, which is how inflation is measured. TIPS are also the only type of investment which offer both direct protection against inflation and are backed by the full faith and credit of the U.S. government. You can buy Treasury inflation protected securities from banks, brokers, and TreasuryDirect.com, the website of the U.S. Treasury. TIPS are available with maturities of 5, 10, and 30 years. If you would like, you can also resell them on the secondary market before they reach maturity. The initial price and the interest rate for TIPS is determined at the time when the U.S. Treasury auctions TIPS to potential buyers. Because the principal value of a TIPS fluctuates along with inflation, only the coupon interest rate is fixed for the life of the bond. Therefore, the amount of interest you receive from one payment to another may go up or down. In simple terms, if inflation was to go up by 5% between coupon payments, you could expect to see an increase in your next coupon payment by 5%. If you buy a TIPS when it is issued and then hold it until maturity, it is a pretty straightforward investment. However, if you buy a TIPS after it is issued or before it reaches maturity, it is a more complicated investment than a normal Treasury bond. There are several reasons Treasury inflation-protected securities can be more complicated than normal Treasury bonds. With a normal Treasury bond, the value of the bond moves up and down as a result of changes in interest rates only. As we've just explained above, TIPS also rise and fall in value with inflation, which adds another level of complexity when evaluating these bonds in the secondary market. Because the coupon payment is lower for a Treasury inflation-protected security than a normal bond issued by the Treasury, they are more volatile than comparable bonds without the inflation protection component. For these reasons, we recommend only investing in TIPS if you plan to hold them until maturity. That's our lesson for today. Please feel free to leave any comments or questions in the comment section below. For more great bond news and education, also be sure to visit us at LearnBonds.com, follow us on Twitter at LearnBonds, and like us on Facebook at Facebook.com/LearnBonds page. Thanks for watching.